Alright, so hi, this is the Cambridge IGCSE Accounting, paper 1-3 from the October-November 2019 session. Um, yeah, so let's just start. Question 1. The MCQs and the first MCQ is usually from the accounting principles. So the question says, part A says, insurance paid by a business included $400 relating to the owner's private house. This amount was not included in the income statement. Which accounting principle was applied? Right, so he's saying that the insurance paid by a business relating to the owner's private house, sorry, the insurance paid by a business included $400 relating to the owner's private house. So these $400 related to the owner, right? And this amount was not included in the income statement. So which accounting principle was being applied here? So in part A, he's given you the option of excuse me, the matching concept. Now the matching concept says that the revenues of a business should be counted against its expenses in the income statement. So this doesn't really have much to do with it. And if you take a look at part C and D here, part C says duality, and duality concept says that every transaction is double-sided. One thing gets debited, the other gets credited, or vice versa, right? Part D is the option C says prudence, and the prudence concept says that the profit and assets of a business should be understated in the income statement and balance sheets, etc., etc. So this too doesn't have anything to do with the event he's told us here. So the answer is obviously going to be B in this case, because the business entity concept actually says that the transactions related to a business are kept separate from the transactions of its owners or shareholders or whatever. So this is going to be our answer. Okay, part B. He said he's giving you some transactions here, and then he's saying which statement is correct, right? If you take a look at this account, he says that the following account appeared in Jacob's ledger. So we're in the books of Jacob here, and the account is of Cindy. Alright, so if we just take a brief look here, there's alright, there's a balance brought down over on the credit side, and there's purchases, and then on the debit side there's returns, bank, discount, and then a carry down. So first look, you should be able to see this through that this is actually a purchases account from Cindy. Alright, so it means that Cindy is technically let's just take a look at that later. So he says which statement is correct. If you take a look at the options here, it says Cindy paid Jacob 441 by check on 29th August. Sorry, 29th August. This is the entry we're talking about here. Bank 441. So the bank is being debited in Cindy's account. So it means that the actual Cindy account entry in the bank account would be a credit. All right, a bank is an asset. So all right, let's just look at this here. Cindy paid Jacob. So if Cindy paid Jacob, it means that Jacob's bank should be going up. Bank is an asset, and assets are debit. All right, so it should have been debited if Jacob's bank was increasing. So the double entry with this would be debit bank and credit Cindy account. So the bank should have been over on the credit side, but it's not. So this means that actually jacob jacob paid Cindy, right? So this option A is going to be wrong. All right, so option B says Cindy purchased goods 390 from on credit from Jacob on 14th of August. So on 14th of August, it says here purchases 390, and purchases is being credited. So this means that actually these shouldn't have been these Cindy didn't purchase goods, she actually sold goods, right? So it's a purchase for Jacob because Jacob purchased them, and it's a sale for Cindy, who sold them. All right, because it's over on the credit side for Jacob, it means that purchases are being debited, and so Cindy is being credited, right? So this is how it works. So this option is also wrong. And then option C says here Jacob allowed Cindy $9 cash discount on 29th August. Right, so cash discount. So this yeah, this can't be because the discount is counting against the purchases, right? So it's decreasing the purchases. So if it's decreasing the purchases, it means that actually Jacob received the discount, to which he availed it, and reduced his purchases amount that he was actually supposed to pay. If the discount is over on the other side of the purchases, it means that whoever he bought it from, actually they offered him the discount. So in this case, we know that Cindy actually sold goods to Jacob, and Cindy gave him a $9 discount. So this means that Jacob didn't allow Cindy, actually Cindy allow Jacob a $9 discount, right? So automatically this leads us to um, option D, which is supposed to be correct, but it means that, let's just read it through. Jacob owed Cindy $450 on 1st of August. All right, 1st of August, the balance brought down is 450, and it's over on the credit side for Cindy, right? So if somebody's account is credit at the start of the year, that means that we owe him, right? It's a liability. That's why it has a brought down over on the credit side. We owe him, and so that person is a liability. So option D therefore is correct. All right, part C. He says, what is not a requirement of the accounting objective of reliability? So let's just see through the options here. It says information must be prepared with suitable caution applied to any judgment. Yes, because if you should be in your senses and the information should be correct, and you should have properly judged it in order to make it reliable, right? And the information should be free of from errors. Yes. Should be free from bias. Yes. So technically these three are right. Information must be available in time for decisions to be made, and this is not a primary requirement. Yes, it's important, but it's not a primary requirement. The primary requirements are that it shouldn't have bias, it shouldn't have any errors, and it should have been made with a clear judgment. So this is A is going to be the answer. I forgot to tick the last option, which is going to be D for question 2. All right. Now part D, he says on 2nd September, Tumelo purchased goods on credit, list price $4,200, less trade discount of 20%, and a cash discount of 2% if the invoice was paid within 30 days. All right. On 5th September, Tumelo returned 1/3 of the goods to the supplier. Which amount of did Tumelo enter in his purchases returns journal? All right. So it means that Tumalo didn't pay, right? He didn't pay. It doesn't say anywhere here that he paid for the goods, but it does say that he purchased goods on credit, which means that he was going to pay later, right? So, and he says that, and a cash discount of 2% if the invoice was paid within 30 days. Now he didn't pay, so that means that we are not going to include the cash discount of 2%. Now let's just calculate the value. The actual price was supposed to be $4,200. He got a cash less trade discount of 20%. All right, 20% of 4,200 is $840. So subtract that, and if Tumelo had paid within 30 days, if the examiner had said so, we would also have deducted the cash discount, but he didn't pay yet, so we're not going to subtract 84, which should have been the cash discount from the actual list price. So this will leave you with, oh sorry, yeah, he says that he returned 1/3 of the goods to the supplier, which means that he kept 2/3. So we have to divide whatever value we get by 3, right? So or an easier way to express this is that, so yeah, this value is actually going to be $33.60. So that means that this is the actual amount he would have had to pay for, but he returned 1/3 of the goods. So 1/3 in multiplied by 33.60 gives you 11.20. Alright, so this means that he returned $11.20 worth of goods, and so enter in his purchase returns journal. He's going to put 11.20 in his purchase returns journal. So B is going to be your answer. Alright, part E. Which statements about debentures are correct? This is an easy one. So debentures carry a fixed rate of interest. Yes, you may see 5%, 2%, whatever, according to the rates and what the bank agreed on. Second, debentures do not carry voting rights. Yes, in a company, debentures do not carry holding rights because that's a bank. Bank doesn't have anything to do with dictating the policies of a company. All right. Option C, it says debenture holders are members of the company. No, that is completely wrong, because it's just, well, just doesn't happen. right? And in 4 he said debenture interest depends on profit of on the profit of the company, which doesn't make any sense. No, this does not happen. Debenture interest is fixed. It does not depend on anything. Our holders of the all right, yeah, we've done that. All right, so this means that A and 1 and 2 are correct, which leaves you, yeah, with option A. Yeah, option A is correct. And in part F he says the totals of a trial balance did not agree. Which error caused this? Let's take a look at the options here. In option A, he says a check paid to Hong for $500 had been credited to the account of Heng. So paid. If anything is paid, it's a debit because it's an expense, right? So a Hong paid to Hong for 500 had been credited to the account of Heng. So this means that the debit side of a trial balance is actually understated, right? Because this amount has been credited now. So the credit side has gone up, but the debit side has gone down because the 500 has been included in the credit side and not on the debit side. So this is going to be your answer. Okay. So part G, he says Sally provided the following information at the end of her financial year. What was Sally's gross profit margin? All right, so gross profit margin is the gross profit divided by the revenue. So the formula for the gross profit is obviously bringing to mind the format of the income statement, revenue and then we subtract the cost of sales. So the cost of sales is made up of the opening inventory, and then you add the purchases, and then you subtract the closing inventory, right? So revenue, gross profit margin. So we subtract cost of sales from revenue. So the revenue is 44,000, and we subtract cost of sales, which is 3,000 plus 32,000, and then subtract 1,000. That is going to be your cost of sales divided by your 44,000. He's given you the formula here. So this is actually going to leave you with the answer of C, which is 22.73%. Alright, so that was simple. In part H, he says a food retailer purchased a computer and debited the cost to the purchases account. Right, so what was the effect on the profit for the year and the non-current assets? Okay, so the thing is that a computer is actually an asset for anybody, alright? So this should have been debit assets, but he actually debited the cost to purchases, right? So now purchases are overstated and assets are understated. So if the assets are understated, then the balance sheet, yeah, obviously the assets section will be understated. And if the purchases are overstated, then that means that the cost of sales will go up as well. If the cost of sales go up, then the gross profit or the profit for the year is going to go down because purchases is a debit value. It counts against your incomes, right? So that is going to decrease your profit. So understated profit, yes, and understated assets, yes. So your answer is going to be D. Part I, he says Hassan's trial balance did not balance, and a suspense account was opened. It was found that the total of the discount received column in the cash book, $173, had been debited to the discount allowed all right, discount allowed account in the ledger. Which journal entry corrects this error? So the thing is that it was found that the discount received, now the discount received is an income, all right? If you have to pay less, then that's an income for you, right? So a discount received is actually credit in nature because it's an income, and a discount allowed is actually an expense. If you give somebody a discount, it means that they have to pay you less, which means that that is going to be an expense for you. So that means that discount allowed is going to be a debit account. So the thing is that to correct this, yeah, he's asking for which journal entry corrects this error. So it means that it had been debited. All right, so if the discount allowed account has been debited, and it's a debit account in its nature, we have to credit the discount allowed account. So this means that the discount allowed account, we have to credit it, right? And the discount received account should have been credited, and it's credit in nature, so we have to credit the discount received account as well. And that means that to cancel these to balance this entry, we have to debit the suspense account, right? So that the option, if you take a look, A, do not be confused with this. This is actually debiting the discount allowed and received and crediting suspense. I've made this mistake a lot of times. So you have to read through the options correctly. The correct option is actually option D. All right, in part J, he says, whatever this name is, financial year ends on 31st December. On 1st January, she purchased a machine costing $18,000. The machine was depreciated by 15% per annum using the straight line method. The machine was sold on 1st January 2019. All right. So because it's the she's depreciating it by 15% using the straight line method, we can just calculate the year charge for the depreciation, which is going to be 15% of $18,000. That is going to give you $2,700. This amount is going to decrease every year. Now, if you calculate the amount of years that passed from 1st January 2015 to the 1st January 2019, I've made a little thing here to make you understand. So 2015 to 16, 1st January 2015 to 16, that is 1 year. And then 2016 to 17 is another year. All right, and then 2017 to 18 is another year, and then 2018 to 19 is another year. So that means that 4 years passed, and this means that you have to depreciate the whatever machinery she bought by 4 years. So this means that $2,700. That if you have to multiply that by 4 for one, all right, and then subtract this value from its cost. So that is going to give you 18,000. Take away whatever this is, 2,700 into 4, which is going to give you your answer of $7,200. And the correct option for that is B. All right, so let's just move on to question 2. Alright, so question 2, he says Aisha is a retailer. She buys goods from Kadir, a wholesaler. The exchange settled documents during September 2019. Alright, so she is a retailer and she buys goods on credit from Kadir, a wholesaler. Alright, the following incomplete document was issued on 18th September, and the incomplete document is a credit note. And we know that debit notes, credit notes, statement of accounts are all sent from the supplier, which in this case is Kadir. Alright, so okay, there's an addresses, dates. Alright, so in part A, he says insert the missing figures in part 1 to 3 in the above document. Okay. So he's asking for the unit price, he's given you the total, and he's given you the quantity on the left here. So all you need to do is divide 70 by 4130 and you get the answer, which is 4130 divided by 70 is 59. Okay, $59. And then he says less 20% trade discount, which is 20% of 4130, which is going to give you $826. Now the discount obviously has to be subtracted. He says less, and when you subtract 826 from 4130, you get 3,304. Alright, so in part B, he says name the person who issued the above document. Now the above document is it's a credit note. A credit note is technically it's a sale return, right? And a debit note is a purchase return. So we know that the debit note, the credit note, and the note of statements of account are all sent from the supplier, which is Kadir in this case. So the person is going to be Kadir, right? Because he's the supplier, he sends the return notes, he sends the statement of accounts, which shows all the remaining balances, all the transactions that took place during the year. Okay, and in part C, he says suggest one reason why the credit note may be issued other than correcting an overcharge. Okay, a credit note is a return, right? So you can return goods if they came damaged or if they were not per your order. Maybe you ordered something and he gave you something else, so you may want to return it, etc., etc. And okay, and in part D, he says state why it was necessary to deduct trade discount on the credit note. Okay, so one reason can be that maybe in the actual invoice the actual bill. This is a return, right? So maybe in the actual invoice the discount was given, so obviously he has to deduct trade discount from the return note as well, because it was given in the invoice. So you need to balance the discount off from the return note as well. Okay. And in part E, he says, name the book of prime entry in which each trader which would record the credit note. Okay, so the credit note for Kadir is it's a sale return, right? So it's going to be in the sales returns journal. So Kadir sold Aisha some stuff, and Aisha wanted to return it. So for Aisha, it's going to be a purchase. She purchased it. So it's going to be over on the purchase returns journal. And similarly for Kadir, it's going to be on the sale returns journal. Okay, because Kadir sold it, so it's a sale for him, and Aisha bought it, so it's a purchase for her. But Aisha is actually returning it, so it's going to be over on the purchase returns journal. Okay. Then he says on 1st September 2019, Aisha owed Kadir $3,400. During September 19, Aisha and Kadir exchanged the following documents in addition to the credit note. In addition, all right. So September 4, invoice for goods, and then okay, whatever. In part F, he's asking for name the book of prime entry in which Aisha would record these documents. If the document is not recorded in a book of prime entry, write no entry. Okay. So the first transaction which took place is September 4, and it's an invoice for goods 8960. So okay. Yeah, in the books of Aisha, he says in the books of Aisha. So Aisha received an invoice for goods, which means that she purchased goods from Kadir, right? So the invoice is actually going to be over on the purchases daybook or the purchases journal. All right, and the debit note. All right, so yeah, on the September 13th, it says debit note 3540 claiming overcharge for goods supplied on 4 September. So, a purchase returns journal is not a book of prime entry, right? So it's not going to be over on the general ledger, and actually going to be on the purchase returns journal, which is not a book of prime entry. So it's not going to be in the book of prime entry. So it's going to be no entry, because up in the question he says if the document is not recorded in a book of prime entry, write no entry. So we write no entry. Okay. 27th, he says check to settle balance outstanding on 1st September less 2% cash discount. So because he said check, so it means that it has something to do with the bank, right? So and then there's a cash discount as well, so you know that bank and cash discount are both on the cash book, because Aisha most probably paid money to settle balance outstanding. Yeah. Okay. So she's paid money, and that is going to be from the bank cash discount. So the book of prime entry, which contains both of these, is the cash book. So the cash book. Okay. Statement of account showing a closing balance of 5656. Now, statement of account is actually not recorded in any book of prime entry. In this case, he's asking for a book of prime entry, so it's not going to be over on any book of prime entry. So you can just write no entry. Right. Part G. He says, prepare the account of Kadir as it would appear in the ledger of Aisha for the month of September 2019. Balance the account and bring down the balance on 1st October 2019. Okay. So he's given you all the transaction up here, include, and you have to take note that you have to add the credit note, which is up here as well. Okay. So he's given you the brought down as well. He says on 1st September 2019, Aisha owed Kadir $3,400. Okay, so if she owes Kadir $3,400, that means that it is going to be a credit brought down over on the Kadir account, right? Because Kadir in this case is a liability, because Aisha owes him money, so he's a liability to Aisha. So the brought down is going to be 3,400 over on the credit side. Okay. And then the first transaction is invoice for goods 8960. So this means that Aisha bought goods from Kadir, which are valued at 8960. So this is going to be purchases 8960. Okay, so debit purchases, credit Kadir account. This is how we're doing it. Okay, so And then yeah, okay. So we're done with this one. And the second one is actually debit note 3540 claiming overcharge for goods supplied on 4th September. So we don't really have anything to do with this because it's a debit note. It has to do with the supplier, and it's claiming overcharge. So it hasn't been um, uh, verified by the supplier yet. So this won't have any entry in the Kadir account in Aisha's books. Okay. So September 27th, check to settle balance outstanding on 1st September less 2% cash discount. Okay, so balance outstanding on 1st September. So the balance outstanding on 1st September is right over here. She actually owed Kadir $3,400. So now she's on September 27th, she's paying it by, yeah, she's paying it by bank because it's a check, and by she's also given a 2% cash discount. So this means that she actually owed him 3,400, but she got a 2% cash discount, which 2% of 3,400 is $68. So she actually now paid $3,332 by bank, and $68 is going to be your discount. Okay, so now discount received, sorry, is an income. So this is going to credit the discount received account and then debit the Kadir account. This is going to be the double entry for this. Okay, so I've written it down everything here. Purchase returns. Oh yeah, I forgot this one. Okay, we're doing this one first. Bank. Now she actually paid 3,332, but she also took a a cash discount, sorry, of $68. So that is going to be a cash discount. Okay. Okay. And then yeah, don't you forget that he said exchange the following documents in addition to the credit note. So she actually returned goods to him as well, which were worth $3,304. So she returned them to Kadir. That is going to debit Kadir account. The purchase returns are always on the opposite side as the purchases. So she purchased goods from Kadir, which actually were on the credit side. So the purchase returns are going to be on the debit side, which are worth 3304. Right? Okay. And then you can work out the balance carried down by yourself, but if you look at the fourth um, transaction over here on September 30th, he's given you statement of account showing a closing balance of 5656. Now a statement of account is actually just the summary of all the transactions, all the money paid, received, exchanged, the goods, all the receipts or invoices throughout the month or the year are contained in the statement of account, and the statement of account is given by the supplier. And if the statement of account shows a closing balance of 5656, because it's from the supplier, it means that Aisha actually owes Kadir 5656 at the end of the year, right? So that is the logic to this. So it means that the question has given you a balance carried down as well for Kadir account. So you just have to write that in. So the balance carried down is going to be 5656, right? And then you can total off both sides. This is going to total 12,360 and then 12,360. Okay, and if you didn't calculate the balance carried down, you could have actually got the this carry down by balancing it yourself. But actually, he gave you the carry down, so why not just write it down if you understand what it means? Okay. Okay. In part A, she says, state the name of the ledger in which Aisha would maintain Kadir's account. So Kadir is a supplier for Aisha. So it means that Aisha purchases goods and stuff, whatever, from Kadir. So it is going to be over on the purchase ledger because she purchases from Kadir. So Kadir's account is going to be over on the purchase ledger. Timothy is a trader who buys and sells on both cash and credit terms. He maintains a full set of accounting records and prepares monthly control accounts. And then he's asking for two advantages to Timothy of preparing monthly control accounts. Okay, so control accounts in general help in locating or correcting errors, and they also prevent fraud because you have all the details, you have all the totals, and now you can work out how much money you should have actually got compared to what you actually got. So if there's any error, like for example, if you understated the sales journal, or somebody maybe tried to wind you up or something, you will detect that in the control account. Okay. And the second advantage can be that the control accounts actually give you um, an instant total of the sales or purchases, whatever control account it is of, and then so they help you preparing the financial statements. They give you the total of sales and purchases. You can just put them on the income statement or the balance sheet, and then you can calculate profit whatever you want. Okay. All right. In part B, he says name the book of prime entry in which Timothy would use to which Timothy would use to obtain the following information when preparing his purchases ledger control account. Okay. The purchases returns are in the purchase returns journal. We know that because it's a book of prime entry. A purchase returns journal. All right. The contra entry does not have um, its own journal, right? So it's going to be on the general journal. Right. So if it was really important, it would have had its own journal, but because it's not really specific to anything, so it's going to be over on the general journal. Now, discount received is, you should know that a discount received and bank and cash, these three are always found on your 3-column cash book. Right. So if you received a discount, it means that it should be on the cash book because you had to pay less, right? So that has to be over on the cash book to actually balance out whatever entry you made. So cash book. Okay. Interest charged on overdue account. So the thing is that interest, just like contra entry, does not have its own specific its own account, right? So it's going to be over on the general journal as well, right? Okay. So part C, he says state the meaning of a contra entry in connection with control accounts. State why Timothy made a contra entry. Okay, so the contra entry, as we know, that it's an entry which is made on both the sales and purchases control accounts. Okay, so for example, if there's, and the reason is, yeah, if the same person is a customer and supplier. So for example, if somebody buys stuff from you and you buy stuff from him, so if he pays you less, it means, for example, if you're buying something for him for $100, right, and you pay him only $80. So when he buys stuff from you, he's also going to pay less. So that is going to cancel the effect it had on both the accounts, right? So if you pay him less, he's going to pay you less, and that is going to cancel the effect out, right? Okay, because you won't have to pay him and he will actually receive he will save money, so that will cancel the effect again. Yeah. Part D, he says state 2 reasons why it's possible for Timothy to have a debit balance on his purchases ledger control account. Okay, so the easiest one that I always used to remember was he returned goods after payment. So if he paid for some goods and then returned them, so that is going to end up as a debit balance on his purchase returns control account. Okay, and if he paid in advance to his suppliers, or he didn't avail an offer discount, or he actually overpaid in error to his suppliers, that is also going to result as a debit balance on his purchase ledger control account. Right, so there's a bunch of things here: debit balance, credit balance on sales ledger control account. So this means that you have 2 brought downs, and then again, yeah, 2 carry downs. You have to find out this carry down, apparently, and then he's given you all the data you need. So let's just work this out. All right. Debit balance is going to be over on the debit side as a brought down. Credit balance is going to be over on the credit side. Totals for the month of October. All right. Credit sales. This is going to be over on the debit side of a control account. Okay. Because we only deal with credit sales in the sales ledger control account. Cash sales we are not going to deal with in the control account. If you know the format to this, if you have it memorized, you should know that. Receipts from credit customers. So now you received money from your customers. So that is going to be over on the credit side, right? Debit bank, credit sales ledger control account. Discount allowed to credit customers. That actually reduces your sales, right? So if somebody owed you 100 but you gave him a discount of 20, so now he's going to give you 80, so that is going to count against your sales. So this is also going to be over on the credit side. Discount received from credit suppliers. This doesn't have anything to do with sales, right? So we are not going to deal with this. Returns by credit customers. This counts against the sales as well. So it's going to be over on the credit side. Bad debts written off. Again, counts against your sales. So somebody didn't give you your money that they owed you, right? So that is going to be over on the credit side. Okay, increase in provision for doubtful debts, that has nothing to do with the ledger. Sorry, the control account, sales control account. Contra entry is always on the opposite side of whatever the main nature of the account is. So in this case, it's a debit account, right? So it's going to be over on the credit side. Okay, so the next one is interest charged on a customer's overdue account. So the thing is that if somebody didn't pay you, then you charge interest on his late payment. Okay, so this means that you gain the money. So whenever you gain the money as an interest on an overdue, you actually debit the sales ledger control account because it counts with your sales. So you receive that money, so that is going to be over on the debit side. And then again, you have a debit carry down and then a credit carry down. You just have to write everything down. Now you need to memorize the format or know what you're doing. You have to be really strong at your double entries if you haven't memorized the format. Okay, so the credit sales, as we saw, were 65. So yeah, no, we have to actually start with the brought down. Okay, so the brought down he's given to you, which is 65.30. The next one is going to be your credit sales, which is 78.60. So write that down, 78.60. And then the interest on overdue, as we saw, was $15. Okay, all right. We can just go back down here, back up here, sorry. So now we are going to take a look at receipts here. So receipts from credit customers, this means that we received money. Okay, so receipts from credit customers goes into your bank or your cash, whatever, and this is always on the opposite side of your credit sales in the control account. Okay, so this is going to be over on the credit side, which is 57.82. Just write that down, 57.82, and then write discount allowed, sales returns, bad debts, contra, which are going to be 118, 285, 260, and then 300. Okay, and then we have two carry downs here. What does that mean? The thing is that he's given you the carry downs or the brought downs actually for 1st November. So the debit balance on sales ledger control account on 1st November is unknown. Okay, so this is the brought down on 1st November. And then the credit brought down on 1st November is 80 over on the credit side. So if 80 is brought down on 1st November, so this means that on the 30th or the 31st of October, this $80 was the carry down over on the debit side, right? Last month it was $80 carried down, and then now this has been brought forward, right? So this means that on the 31st of October, this $80 was the carried down. Okay, and then similarly on the 31st of October, this whatever this value was the carry down over on the credit side. Okay, so this is how we work. So $80 on the debit side, that was your carry down. So now what you can do is actually find out this carry down. Okay, so this side is actually going to total up to your $14,485. And then when you total this value to find out the balancing figure, which is going to be the carry down, is also going to be 14,485, and then this is going to give you a carry down of 76.30. Don't get confused that this is way bigger than this carry down. It does happen. You just have to be sure of what you're doing and what the format is, what the double entries are, and you'll get through it. Okay, so the brought down 76.30 on the debit side, and on the credit side it's going to be 80 again. Okay, so that's that. Yeah, so that was it. So let me just explain this again. Thing is that he's given you the brought downs on 1st November. These are the brought downs on 1st November. So if there's a debit balance brought down on 1st November, that is the carry down of last month on the credit side, right? Because if, for example, if there's a brought down here for 5,000, This means that this has been brought forward from the last month, that because the carry down would have been right over here for last month, right? 5,000. And now this has been brought forward from last month. So this means that whatever the brought down is on the debit side, it has to be the carried down for last month on the opposite side. So that is how it works. So I'll cover the remaining three questions in another video. Now, if you have any questions, etc., please do comment down below and like, subscribe, and all that good stuff. And I'll see you in the next part. Thank you.